as something like this, but think about trying to time the market. Every year for over a decade, there has been a reason not to invest. Every single year. It's easy to find a reason to say it's time to wait. Prices are going too high. In 2008, I understand there might be some people who were born late enough. Good job watching a video like this when you're young enough for the education to benefit you for decades. Who didn't live through the 2008 recession as an adult or an investor. I wasn't an investor before 2008. Before 2008, my goal was to work towards a pension. I tried in the Marine Corps, and after Desert Storm, they downsized. I tried in law enforcement, and because of 2008, with the recession hitting, municipalities weren't making a lot of money because they get their money from tax revenue. And if businesses are failing, not a lot of taxes are being paid. So like a lot of other qualified officers around that time, I got laid off. And my chances of getting a pension kept getting taken away. So right around 2008, I made a shift to become an investor. And I saw what happened to people who were relying on flips or an uptrending market for their business model to make sense. Like now we have syndications that are projecting rent increases to continue for the next several years for their model to work. Not something I want to do. So I invest in buy and hold real estate where I don't care if the price goes down because that doesn't impact cash flow. I'm investing for cash flow. I haven't recycled capital. I haven't done a 1031, taken out a HELOC, refied cash out. I would have a bigger portfolio if I did that. I would probably have less cash flow, at least for the first decade or two. But after that, it starts to pick up more. So I totally understand that investing philosophy. But and I have a couple of guests that are going to be popping in today as they get here. We'll say hello to Lumberjack as he jumps into the chat or into the live stream. Hey, Matt, thank you for joining us.
Oh, my pleasure, Dion.
Nice. So I was just covering really quick how timing the market.
Yeah.
Well, and this will give people a few minutes to put some questions into the chat for the three of us. If he woke up because he didn't respond to my email. I get if you have a job on your day off, it's time to sleep, right? He's probably or doing the walk of shame. But so after 2008, home prices crashed. They went down, and everybody right now is thinking to investors how lucky it must have been to be buying properties around 2011. Right? In 2008, it starts to crash, takes 3 years to go from peak to trough. So we never saw a crash more than 8.9% in one 12-month period, but over a couple of years, yes, some markets went down significantly. But lenders weren't lending. Everyone kept saying it's going to drop, and you don't have houses were going for tens of thousands of dollars that are going for hundreds of thousands of dollars now. And people were saying it's going to go lower, don't buy. Lenders said you can only have 4 mortgages in your own name. So conventional lending as an option really was taken away from a lot of people. Some people were over that limit already, expecting to go to 10, and all of a sudden couldn't. And then as prices started to go up in 2013, people said prices are above where they were in 2008. This is unsustainable. Nobody can afford this. It's got to crash. Don't buy. 2014 and 15, we have the silver tsunami. We have all the baby boomers are going to retire and they're all going to downsize. So don't buy because wait till they retire and that will happen. 2017, 18, interest rates went above 6%. Prices didn't drop because everybody, even then, 5 years ago now almost, people were saying for every interest point that rates go up, prices come down 10%. They didn't. They continued to go up.
Yes.
2020, we have a pandemic, an eviction moratorium. 2021, we have the lowest interest rates ever that I remember. So prices skyrocket. So prices are too high. Every single year, there's a reason not to buy. So if somebody's trying to time the market, they would never buy an investment. And do you think anybody, almost anybody, can retire on savings? No. If you don't put it to work in some investment, whether it's stocks, real estate, growing a business, doesn't matter. Timing the market is going to make you poor. So
I concur.
Nice. Well, I appreciate that. I mean, and it continues today. if there's never been a time where people say, I've never heard this in my entire life. Now's the time to buy. Right now. This is the best time ever to buy. Because what's going on in the market really is almost irrelevant. What's going on in your personal life? How stable is your relationship? How stable is your ability to keep income, to qualify for lending? All of the things that impact you tell you whether it's the time to buy or not. There are times in our lives where we shouldn't be buying a property. We shouldn't be adding more stress or
Right.
don't have the bandwidth for it. You have a new baby, you don't go watch a movie for a while, right? You don't take the baby to the theater. There's a period in life where things aren't applicable to you, but not the market. The market doesn't apply to you as an investor. And I'm trying to think of a more eloquent way to say it, but it's too simple of a concept to put into like anything other than a meme.
Yeah. Yeah, I mean, I think that there's deals that I've gotten that are better than others. And those were deals that were during the crash or the recovery, basically buying during the crash. Rates were higher. We were getting rates in the 5s, and during the crash, I was getting rates in the 6s and the low 7s. So I was buying stuff that was a point and a half higher. The numbers had started to come down. Some were already down. Some went down more, but the numbers made sense at what they made sense at. So it's just buying, it's just, staying strong and steady and being disciplined. And I mean, it's unsexy. It's just the way it goes. There's nothing sexy about it.
Boring is sexy. And
they call me Brad Pitt.
Right. What very much entertains me is most of the advice to not take action is from people who don't have investments.
They haven't taken action.
And it's working for them because they still have a job, they still have a house, they're still on track to retire before they're 90. Like all of the things in their mind that are going to work out are going the way they are because they haven't taken the risks of investing. Because there are risks with investing. We mitigate those risks. We have 3 forms of asset protection. We have reserves. We don't over leverage. We research a market before we invest into it. We diversify property types. We diversify tenant types. We take all of these steps that if you just look at investing and you say you could lose money, well, of course you're never going to invest.
Of course. Yeah.
And so every time we have an economic difficulty, my biggest fear always goes back to the same person. It's not the investor. It's the person with their job as their only source of income.
Mm-hmm.
If the only way you have to make money is selling your life 1 hour at a time, what do you do when nobody's buying?
You mean that person that's your renter?
Right. Well, so that was actually the reason we talked about it before off camera, before I made the video. That's why I chose Class C rentals. A lot of my tenants, even though I talk to them and I say, let me teach you how to buy a place like this. Let me introduce you to an agent and talk to a lender. And, you don't have to pay rent. You can live in a place like this and have somebody else pay the rent for you, pay the mortgage for you. Had one tenant buy a house, but right. I like Class C properties because the tenants with a $15 to $25 an hour job, if they lose it, they go find another one.
Yeah.
If you're in Class A or Class B and you're making $150,000 or $200,000 a year and you lose your job, it might take you months to find another one. You might take a 20-30% pay cut to start over at another company to work your way into the type of position you were in.
Sure.
Which means moving, downsizing.
Yes, it does.
Right. So don't know if it's factual. It's what's working for me. And that was what I was explaining in that video. And I like everything that we say is our opinions based on 22 years or 12 years of experience investing. I can't wait to get your experience on retiring early, making work optional based on experience.
Well, I'm just going through the experience right now. I actually called my agent this morning and I put my entire portfolio up for sale. I put the entire portfolio up for sale because somebody in the YouTube comments said that I was going to lose it all. So I figured better sell it all before I lose it all based on their in-depth experience and their review of my financials.
Nice. Well, it's a good call. I do I do like that, you can look at your YouTube algorithm or data, like we can open up the website and see who the people who watch our channel, who they're watching. There are channels that are diametrically opposed to our concepts, who are renters, who aren't investors, who are of course saying, don't buy an investment property. They want home buyers to buy because that's how they make their money. So the people who are watching that will then see one of our videos and come and watch it. And we'll get the comments in the comment section. And I can instantly tell, okay, look, it's good to get both sides. It's good to say, here's all the fear, here's all the reasons why you shouldn't buy, and know that those have been there every year, right? Is there a fear like that in your market? Are you in a place where there's only one or two big companies and one of them is looking at going bankrupt? Okay, find another market. But if for 2 years straight, someone watching our channel is watching a channel that keeps giving excuses and reasons to say, don't take action because of these reasons, and they've been wrong for 2 years. I've never made a call of prices are going up, so you should buy now before they go up. Prices are going down, so you should buy now. There's never a reason to buy now. There's never a reason not to buy now. It's what's going on in your personal life, and buy the great deal when you find it. If you find the great deal tomorrow, you buy it. But if you hunt for a great deal and you don't find one for a year, then it takes you a year to find one. It doesn't mean you wait for a year for something to change in the market before you take action.
Yeah. With payments, with rates that were so far down and pricing taking long, it basically is causation, which is rates plummet, prices start to go up, right? But we were buying in that sweet spot where rates had plummeted. I was getting commercial debt sub 4%, and I was getting my 30-year fixed stuff at 4%. Everybody else was getting it at 3.25 or 3, because I'm an investor and I have to pay more. But that made every property, I was like, nope, their numbers are off. Nope, their numbers are off. It showed me that 90% of agents have no clue how to understand what an actual payment is. Idiots. They just don't get it. It's like if you are thinking like an investor, and then they wonder, why do we keep on losing these houses? We keep on losing them because you can't do math. You can't do math. It's the math. It was very simple. So I was happy when they were like, well, this is the highest this house has ever sold for. No, it's not. Yeah, it is. It's the highest it's ever sold for. No, it actually isn't. It's actually got a lower payment than when they bought it 10 years ago.
There's two ways of looking at that. One, you have the affordability based on payment, inflation, wages, and all those kind of things to kind of do this factoring of when is the best time or most time. And then the other side is like the Homer Simpson version. This is the highest this property sold for so far.
Yeah. I mean, that's the other thing too, is I think Alex Hormozy said it best. He said, you can tell how rich a person is by what their time horizon is. So he's like, if they're talking to you about, I need money now, he goes, they're poor. He said, if they talk about needing money this week, they're poor. And he goes, if they talk about it this month, he goes, maybe they have something moving or shaking. Maybe. He goes, if they talk about this year, okay, now we're starting. He goes, if you talk to somebody that's 10 years out, he goes, that's a wealthy person. So that's
I haven't heard that. It's a great way of looking at it. I like the moles, months of life.
Yep.
Yep. I before we get into the comments, and I want to say hi to everybody who's taking their time on a Friday to hang out with us, which I really appreciate. I really like the difference between rich and wealthy. I almost titled this video a version of Rich and Wealthy. Yeah. But the timing the market won out when I was going through the list of subject titles. If you have a lot of money and you spend a certain amount of money every year, you have so many years you can live. If you have money coming in that you don't have to work for, you basically, like the wealth equation is how many months can you live before you run out of money? And if the money coming in is more than it takes you to live, you're infinitely wealthy. And that's what I'm hoping to get more people to.
Yes.
And one of the things, sorry.
No, go ahead.
I want to convince some people who are there that you might not have to keep working. Good morning, Ring Seeker. Howdy. Good to see you here. And I saw that when you were there, there was already like a like or two on the video. So I appreciate that if that was you. Amafid, howdy. Chester Williams, good morning. Ring Seeker, I am house cost averaging, but I like that. I might steal that. Been looking for a way of saying I do dollar cost averaging, but in the housing thing. That's great. So bought in October, now closing today. This deal was better than the last. That's the goal, right? Every deal better than the last one. Yes.
Yep.
And so that's a Michael Zuber. Every purchase, especially going into a recession, purchase should be better than the last, because recessions is when the opportunities happen. And the thing that I like about watching the REI Avengers or the Three Amigos is that, the multiple ways of looking at this. And with Zuber having over 187 units, the last count, every deal should be better than the last, because he's not in necessary growth mode. Like, he doesn't need to grow to reach financial freedom. Like Matt, based on the comment, he could sell a portfolio and walk away with $1 zillion, right? When starting out, I think I'm a fan of base hits. I don't think any of my purchases were ever a home run. And a lot of people get home run itis. If I don't get a 10% return in the perfect market with very low tenant turnover and just all this list, you don't get everything, you're never going to buy, right? If you don't hit all everything, none of my properties, none of them hit the 1% rule. Not all of them had all of the criteria that I list off that I want. They had, 80+%, right? Mm-hmm. Get those base hits. And my best deal, I think, was probably my triplex, which I purchased in November of 2020. So during the eviction moratorium and all that stuff going on, I had my best purchase. My next purchase wasn't as good. So it was, every deal wasn't better, but it was a base hit. I purchased a duplex in 2021 that other investors who were trying to time the market told me not to buy, that it was a dumb reason to buy. People don't have to pay rent because the eviction moratorium was still going on. There were 2 for sale. I tried to get another investor to buy the one across the street. He didn't. And that still ended up being over a 10% return. I've had no tenant turnover. Everything I think I've spent maybe $500 in repairs on that duplex since I've owned it in over, a year and a half now. So it was base hit. It doesn't have to be better and better, but it's a good goal to have.
Yeah. Like my last deal was about 20%. The deal before that was 35. The deal before that was 39. Like, what am I supposed to do? Wait for the next 39? No.
Right. So, but I totally get what Mike means when he's talking about we're going into a recession. We're going to find more and more, the more motivated seller, not more motivated sellers, but the seller that's the most motivated.
Correct.
Brian, howdy. Good morning. Cody, good morning. Phil, good morning. I believe I have a call this Saturday with Phil, which Phil, we're going to have to make sure the Wi-Fi works. This Saturday, I am going to the Robin Hood Resort for a real estate gathering presentation with investors. And I'm pretty sure, because the Robin Hood Resort sits next to Bill Gates's compound, I'm pretty sure the Wi-Fi or the internet connection there is probably solid.
You're probably not getting on.
Phil won the role for the hour.
Oh, cool.
Conversation that we're going to have this Saturday. So seems my time to be when a down payment and great deal line up at about the same time. Exactly. So it's literally the definition of luck, Phil. Preparation meets opportunity.
Yes.
Absolutely. And then Amafit, I appreciate the random comment in support of the algorithm. I probably butchered the acronym, but it's what it meant. All Nighter Rider, howdy. And we can start now. Nice. Angelina, good morning. Howdy. Was that my mom's name? Everybody called her Angie, but I don't know if it was Angelina or something close.
Learn something new every week.
Something I'll have to find out. My family's weird with names, literally weird with names. So imagine 13 people.
Yes.
With Debbie, Dina, David, Dion, all of us, the middle name's Lee. Like my parents were all D's, all L's, all weird. Ring Seeker. Thanks for derailing my tangent. Have you ever presented a chart of some kind that shows your cash flow over time? I think seeing the slow increase in the beginning, which probably takes off in the later years, would be a strong message. So that's actually a great question, Ring Seeker, because I want to do a video with Matt where we talk about the first 10 years of me recycling cash flow and Matt recycling capital to kind of do a comparison of how much more effective at building a massive portfolio Matt's version is, and how much more effective at retiring in 10 years with the least amount of work to do my strategy was for self-managers. Maybe Matt, if you went property management, maybe it would be even less work than I am.
Yes.
But I kind of want to do that. And if Ring Seeker, I'll do a video with the chart breaking it down too. But my first few videos, if you go all the way back, just open up the app, scroll all the way to the end of the videos. The very first one, it's from 89,000 in bad debt to financial free in less than 10 years. I break down like
Nice.
losing money and renting the house out, moving into an apartment. I step it through all the years up to the 8-year mark. But I probably need to do that again and whiteboard it. So yeah.
I wouldn't whiteboard it.
Mhm.
You gotta do it. You gotta do it in a way that you can keep it, memorialize it.
Well, it'll be on
I
video.
mean, YouTube.
Right, exactly.
You
Troy,
tell
howdy. Oscar, howdy.
us-
Ring Seeker, same request from Matt, probably first 10 years of investing for both. Yeah, exactly. That's what I want to do.
I'll figure out a way that I can do that. I usually don't share financials, but first 10 years, they were probably, it's probably pretty doable because 3 of the years were the Great Recession. So it was 8, 9, and 10 and 11, 8, 9, 10, 11. Yeah. 8, 9, 10, 11. So it was 4 years of the Great Recession, and 07 wasn't that good either. 07 kind of sucked too. So
I could do a breakdown of those same 10 years with you where I
You
go
do-
through a divorce, find
were
out
just-
about the debt.
you were
get
creating
laid off,
debt.
Like
you were
I'll make you
only
feel real
filling
good
out
about
the,
yourself. You'll be
Yeah, you
like,
were
I only lost money in stocks. That's great. I'll
you
take
were
it.
only filling out in the red side of the balance sheet.
Yes. Actually thought I was doing so good. I had never carried consumer debt
Yeah.
that I knew of. All Nighter Hider jumping in with a super chat. I appreciate that. And you are saving for your first base hit, which you will do.
I love it.
Geared for a massive portfolio, 100 plus stores. Good. So Zuber, Millennial Mike, Lumberjack Landlord, they all have strategies that will get you to those 100 plus stores. Try not to listen to me too much. I'm too lazy to get you there.
Yeah, I think that's the other thing too, is that it depends because your journey is a little bit different. Zuber's and mine was different because he was basically growing a portfolio through a team and through a property manager. And so that's where that, differed a lot, is that every single one of my properties I touched, every single one I was there, every single one, it was me managing it and then doing the repairs. And so that's where I was kind of involved in every single day, not really managing anybody, but doing all of that myself. So it depends on what road you want to go down. I think that both stories are important to hear because it might help you decide, do I want to go property management and be ripped off every month and give them more money than I make on the property? Or do I want to be rich faster? Because that's the thing is, I think that Dion, you always say it perfectly, which is building your portfolio out of cash flow is definitely slower and definitely safer. Slower and safer. I think it's the two things that it is. When you're building it out of cash flow and cash recycle, it's much faster. It's also more risky, but it is much faster. And then you kind of tick into the point where Zuber and I differ, which is he's doing it through property management. And so he has fee structures that he has to maintain, which is fine. But then I don't have those fee structures that I have to maintain because we both pay the same for maintenance. The difference is he has an overlying cost to making that call for the maintenance. That's where a lot of people miss it in property management is it's not just that he's got to do the repair for $100 and I got to do the repair for the $100. It's that it cost $100 to make that phone call and I didn't pay that $100 to make that phone call, but I gave up time.
So here's a quick example of something I would talk about in that video where we compare the 10 years to 10 years is, and don't share specific numbers. I know we're trying to make, the goal is it's achievable, it's attainable. So we don't want to say, if you make $4 trillion, of course, nobody's going to pursue that path because
Right.
Who can reproduce that, right? So we want to use Zuber's technique of get to 4 rentals. Your life changes at 4. You might stop at 4, have a better retirement. You might get to 4 and realize, wow, this is super easy. I can get to 10. But this year, total expenses at properties with my well issue, I replaced a garage door. I think if I hunted, I could probably find maybe $10,000 in expenses. And that's a round number I'm making up. It's probably half that, but I'm being overly conservative. I probably spent that much in repairs. I have a box of receipts I could go through. Not gonna, too lazy. But how much money in repairs, rehabs, currently today do you have being worked on? Like it's 6 figures, right?
500,000.
Yeah, right. So recycling cash flow versus recycling capital.
Yes.
If you're recycling capital, you're growing a business.
Yes. Yep.
Okay. And if you recycle cash flow, you're building a retirement.
Yep. Absolutely.
That's probably what I think the end of that video will come to. And there are a lot of people who want to grow a business. I absolutely support it. Do it. Go for it. I'm not an entrepreneur.
When Dion goes to Bali, I'll just have the bigger mountain.
I'm actually glad you brought that up because I wasn't going to reference this unless somebody else brought it up. Did you see that Indonesia just banned sex outside of marriage?
Yeah.
The country that has public flogging.
Guess who's not going to Indonesia anytime soon?
And that includes Bali. So, I mean, never mind.
Boy, those plans just got ruined.
But it's significantly changed.
But I think it's really important that we continue to make the differentiation. I love your model. I just wanted something massive. And
what's your goal?
Exactly. 100%. For me, I was looking at it and saying, I want to be in the position where I make, quite frankly, like 6 figures a month is kind of what I wanted to see. I wanted to make 6 figures a month.
And I wanted probably around 6 figures a year.
Exactly. Yeah, 100%. Well, your kids are already done college. So, but I think but that's why I love this, is because there's absolutely merit. The other thing too is time horizon, right? You started at 40. I started at 22 or 23. And so for me, it was like, well, I can spend all my life and spend all my time doing this. And then at 45, still be so dumb that I keep a job. But can transition out of that job literally every day. I have my Dion moment, which is maybe I'll quit today, but not today.
Someday you'll have a day that's good enough.
It's going to be that too.
And
it's so going to be that.
And just in case they don't, but just in case my kids ever watch this, you made a statement I want to clarify. Only one of my 3 kids has made the mistake of going to college.
Oh, good for them. See, you raised really smart kids.
2 of them. Yeah. Tony, good morning. Howdy. Morning, howdy. I am speaking at Cody and Christian's estate event this weekend. I will be there Saturday afternoon, later in the day. And then maybe a bit of Sunday morning.
Cool. Awesome.
But definitely hungover. And also ducks own dragons. Agreed.
Do you want me to, Cassidy just reposted a question. I can answer it pretty quick.
Yes.
It says, I live in a small town with a population of about 16,000. A 50-unit apartment building is nearing completion. What sorts of effects can I anticipate as an investor in this area? 0. Probably 0.
I would, on that side, I would say rents are probably going to go up. Yep.
So I would say the negative impact you can expect is 0. The positive impact, you'll far more likely see an increase in your rents because a rising tide lifts all boats. And those 50 units, I would be getting a brochure from there of what they expect their rent, because I guarantee they're trying to rent them now. See what their pricing is. There was a building. So Cassidy, I'm in a town. One of the towns I'm in is 27,000 people. So it's a little bit bigger than your 16, but I have another one that's in the 16 or 15. It's 26,000 people, 27,000 people. They just did a building of 144 nice luxury apartments. On average, their units are $1,000 a month more than mine for about the same floor plan. So They're $1,000 more than mine now. They were 1,500 more than mine when they brought it to market. So I was able to raise my rents $500 on a 2-bedroom unit because their other option was, well, hey, you can overpay $1,000 and move in there, or you can pay $1,000 less and stay where I am. And the difference is that building had a doorman. I mean, I guess if you need to feel important and you need somebody to tip in the wintertime, sure.
Yeah, a lot of people, when they're investors, they get concerned when they see new builds going up. And I've been driving around with friends that know I have rentals, and then we would see a build going up of a big apartment complex, and they go, "Oh, that must suck for your rentals." And I don't take the time because they're not ready to hear, right? And explain. I go, "Yeah, sure, whatever." But two things happen when new builds happen with rentals. First, nobody builds a multi-million,
Yes.
50 plus, 20 plus apartment complex and then rents at a loss.
That's right.
So they're going to raise rents. They will make rent concessions. So they might go first month free, first month half off, no deposit, whatever to get the ball rolling. So you might time your listings with their listings, but it is not going to cause rents to go down. I've never seen that.
Here's one of the things I also saw happen. So half first month, no first month, $100 security deposit. I wonder how that worked out for them. And then the other one that I saw, and then one that was like, people were like, "Oh yeah, it sucks now. They're charging for parking, $150 a car on a 2-bedroom. That's $300 a month. That's a lot of money." And I'm like, you don't put that into figuring out the increase. The $2,500 a month rent that you were paying that also went up 10%. Now they're charging you for 2 spots. That means your rent effectively went up 20% for those of you who can't do math. It's a lot. It's a lot. So I love seeing those new builds because they can't, the issue is those new builds bring in new people, because people are like, "Oh, I'm living in the town next door, which has a bunch of new stuff. But this town over here, they have a bunch of much nicer stuff that's now brand new." It's like the casinos out in Vegas. They're always the most expensive per nightly fee. The brand new ones, they're always the most expensive. Like Park MGM, that was more expensive than Aria, and Aria is a much nicer hotel. Based on experience. I spent a lot of time at Aria. Used to.
Last time I went to Mandalay Bay last time I was there.
Mandalay Bay is nice.
Apparently staying on the 32nd floor gets you weird comments from everybody. All-nighter hider. One source of income leaves one open to a single point of failure. I agree. That's my fear when it comes to the people facing a recession. And I see this often in a YouTube channel with the guy who's renting that talks about all of the failure reasons. A lot of the comments literally saying, "Thank God I didn't buy last year. Look what happened to rates now." Like absolutely uneducated idea of how real estate works. And my brain breaks now every time I use the word uneducated because I'm thinking of how smart the uneducated guy is that we watch. Cassidy. Howdy. And that was your question that we repeated. Good.
Yes.
All-nighter hider. People love their simplicity. That's fine, but don't expect simplicity from a very elaborate subject. Get elaborate with it. If you can't explain something simply, you don't understand it well enough. That was the thought process at the truck driving school I was at. And when you're explaining concept, if you can't explain it simply, don't explain it. Find somebody else to do it.
Yes.
Consider the logic. Howdy. Not something that very many people do. Here for another like and comment. I appreciate it. Phil, looking forward to the call too. Let's see. I think I read some of these. Someone was creating that for me. Yes. Can I overshare? I shouldn't overshare. A $12,000 freaking weekend. Took 3 of our friends to Chicago. Okay. Paid for all the flights, the hotels, rented the cars, paid for the male companionship for the weekend. All-nighter hider. I'm gonna get off that. It's okay. I listened to all REI Avengers and picked the tools that apply to my situation best. Yes, that's what I do. Mm-hmm. Like I'm not trying to have 100 and something portfolio anything. Mm-mm. But when I'm gonna replace countertops or look at, we did the electric video together 2 months ago now. and a tenant turnover going in. I went to your content to figure out, okay, what's the best way, best buck, best use of capital on this tenant turnover with electrical. So I don't need to have to want to do what you're doing. I don't want to invest out of state, but I watch Millennial Mike. I take in his content.
Absolutely.
I look at all kinds of things that come in there. And I don't want to live or own or think of California very often, but I still want to learn how Mike invested in living in a high cost of living area in a state that's very tenant friendly, found a way to make it work.
When you find somebody that's doing what you're doing. So I had a guest on my show, Matt Peterson, and I was in awe for 30 minutes. He was the guy who talked about basically getting rich off dirt. And I'm just sitting there going, this is the coolest. I have never done anything other than buy a lot. I've never bought raw land. And he buys raw land and makes millions of dollars buying raw land. Oh, we woke somebody up after their ramen.
My bad, man.
Finally made it home, huh? Good.
Hey, look, in my defense, you guys said we're starting in 10 minutes, 10 minutes before. Nobody said the time.
The time was set like
he said Monday. The time right in
was
there.
it?
You don't know how to read?
All right, my bad.
Maybe I
wasn't paying attention to the group chat if that's the case. I didn't know we were going at 8:30.
I literally asked the time, and you know what, Mike? I knew what the time was. I asked it for your benefit. Team player.
My bad.
It's all good.
It's all good.
I totally understand that if you have a job, you might get tired, you might need rest. This is literally a live stream between naps for me.
My 5-year-old's kicking my ass a whole lot more than my job is. I mean, honest to God, he's been in my bed like 2 nights out of the last 3, and I'm like, feel like I've learned a whole new level of kung fu. Nocturnal kung fu. It's ridiculous.
I get the feeling that your house is going to be a lot like mine, Matt. So I had 3 kids, right?
Yes.
And they're older now. But we always had 5 kids.
Yeah, it's definitely going to be like that.
Like, I don't know what it was. Single parent. I was just at home when I wasn't at work, and I didn't want my kids going somewhere. So I'd either have their friends at our house. And my son had a friend who basically had like absolute lack of parenthood at his house. So he basically grew up at our house. So you only have this many, but you end up raising close to twice as much.
Mike kind of saw it. Millennial Mike woke up to walking into Mig soup every morning.
Dude, like those kids were running through the house.
They love morning.
Just boom, 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 boom. I don't even need an alarm. Sammy's waking me up. We're good.
Yeah, exactly. It's like, hey, what's going on? Like, I'm the welcome committee. It's like, bro, relax. It's 6:30. Relax.
All-nighter hider. I'm not a property manager, just pro self property manager.
Yeah.
I'm not a property manager. Don't have a property manager. I'm a lazy self manager.
Yeah.
Get the systems in place. And I like the phrase of treat your tenants like you only have one and your properties like you have 100. Put a system in place to make it work like that. Consider the logic. Thank you. All-nighter hider starting at 41. Perfect time to start.
It is. Dion, I think that's really important too for you have done a really good job of how you've onboarded properties. And so when you onboard them kind of in a more thoughtful way, like we have our processes of how we onboard, and so we can onboard quickly. The biggest challenge for us is we had too many that we were onboarding all at the same time. And so when you were doing deals, it was slow, steady, measured growth. So I think your biggest year was 3 deals in the same year, right?
2. Yeah.
2 in the big, yeah.
2 in the same year, yeah.
That's perfect, because just so you guys know, the bank looks at that. I had to have multiple conversations with my bank, petting them on the head. It's okay. I know I'm adding fast. It's okay. Don't worry. We're all going to be all right. And that's the conversation when you're adding quickly that you have to have. The Dion's approach of measured is actually a far better approach, because then he could dial in the property, dial in the tenant, know that they're worth keeping, know that if they need the binder strategy in the first 60 days, all of that stuff you can do faster, because that was the biggest challenge, admittedly, for us, is 17 properties in 18 months. That was our biggest challenge, was onboarding all those places. We're still getting through it now. And Millennial Mike saw that a lot. That's what's taking the most time right now, is just stabilizing all of those units. but we also have $500,000 worth of projects going on. So admittedly, I am working harder now than I ever have, but I already see the light at the end of the tunnel. Like I'm thinking June to August of next year, it's going to be pretty boring around here again, because all of our units will have been redone. All of our tenants will be stabilized, or all our units will be stabilized unless we add a bunch more. But I don't see that happening just because I'm not seeing really good deals anymore. So I think that slow and measured is really good, Dion.
A lot of it comes down to your goal, right? And how are you trying to create another job? Which you said, you're working now harder than you ever have because you created a job. I have a friend named Pasha who he did a deal deep dive with me on my channel and got like 14 units in his first year or something. And it was just, he's a system person, like he gets the systems. But I can see the stress of if you add it all at once and you're dealing with all the same things at the same time, kind of like, you have $500,000 in projects going on right now. Hard to deal with that in your first year before you have the cash flow, the reserves, the income to do that. Once you get 20 years in and you're like, yeah, it's just kind of a normal year. We have this, I mean, it might be a little more busy because you did more purchases last year than you normally did.
Yeah.
Easier to handle it then. So we're right back to don't compare year 22 with year one.
Well, I think the other thing that allowed us to do it too, and I think it would probably, I don't want to assume this, but based on what we'd done, we had the processes in place to do 17 in 18 months. It doesn't mean it didn't suck. Like it was really hard still, but I would imagine if you've not done 5 in a year, that 17 could have flipped you upside. Like you couldn't have probably done 17 because it's just everything on a bigger scale. And so for us, it's stress tested all of our processes. So now I come out of it saying, because we haven't bought anything in 3 weeks, but we've only bought that one thing in like the last 3 months. And so I come out of it now looking at it going, okay, all of these processes stood up. All of them were stress tested. All of the angles, all of the processes, using the binder strategy that we did with a number of tenants, all of those things actually worked really well. And so that to us, it was kind of, wow, that was hard because it was time, but man, that was cool because everything kind of stood up with really not a whole lot of modification, which was good.
So I have a question for Mike here, but first I want to say, if you want to grow a business or if you want to invest for retirement, financial freedom, what Matt is doing and what Zuber did is totally worth it if it's what you want to do. Because imagine the economy of scale. We try not to talk about numbers with Zuber or with you because, again, it's unattainable. If you think that's the only goal, you can't be on the path to get there. I added 2 properties in 2020 and 1 property in 2021. And none in 2022. So this is how much the numbers changed in 1 year without adding any properties.
Right.
2021, $128,000 in profit. 2022, $203,000 in profit without adding any properties. Just stabilizing binder strategy and the snowball effect happening of 16 units having an adjustment in income versus the first 2 or 3. And Mike, I don't know if you saw the title of today's video before you jumped in, but it's trying not to time the market. And I talked about over a decade, there's been a reason every year not to buy. There's still channels talking about how this is not the year to buy, just like the last 10 have not been the year to buy. I want to ask you, how are your BRRRR projects going? Because having multiple exit strategies is the way to like defend yourself from a market shifting in a way that you're not ready for or you don't want to happen. So a little over 6 months ago, you purchased 2 places, planning to do a BRRRR. And in that 6-month period while you're doing them, interest rates double. So walk us through how that started, went, and where it's looking like it's going to end now.
Sure. So I bought 2 different BRRRRs. One of them in Chicago, which was about 30 minutes away, 45 minutes away from all my other properties in Gary. The other one I bought in Gary. And this, I literally have a video coming out explaining all of the numbers in complete deep detail. It releases today, 5 o'clock on my channel for the Chicago property. So if somebody wants to see all the math, everything completely broken down, watch it. But this is as Charles Dickens famously wrote about, A Tale of Two Birds. I don't know if you guys caught that book as a kid, but I did. Because one's going exceptionally well, the other one did not. It didn't lose money, but there was a major difference. So let me explain. The first one I bought in Chicago. I wasn't quite as familiar with the market. Wasn't quite as familiar with the appraisals. And then, of course, I did not anticipate that interest rates were going to go as high as they did. Back when I bought these properties, Matt and Mike Zuber had estimated, they thought interest rates were going up. They thought that maybe we'd see above 6% this year, but nobody had estimated that we were going to get all the way to 7.5%. And at that time, Dion, even you were saying that you thought interest rates might come down near the end of the year. So when I estimated for my interest rate, my like worst case scenario, I was like, well, I'll just estimate like a 6 or a 6.5%. Well, I ended up with like a 7.5% interest rate. So really bad. And then the other thing I didn't anticipate was that appraisals were going to get knocked down because interest rates were going up. So I looked at comps based on my friend who educated me on the market and other stuff I'd looked at. The after repair value of properties that were similar to mine in that neighborhood was $100,000 to $110,000. So I was like, okay, I should probably fall right in here. There's no reason why I wouldn't. But at the end of my Burr project, I ended up getting an appraisal for only $90,000. And my interest rate was 7.25 or something like that. So I have a higher monthly payment and a lower appraisal, which means I can't cash out as much and pay myself back as much money. So again, I encourage you to watch the whole video. I still make a 10% cash on cash return on the property. I still have like $200 in cash flow monthly. So it's what I would consider a good deal. Back then, if I had bought it in Gary, it would have been like a good deal, but I don't do good deals. My average property is like an 18 to 22% cash on cash return with $250 or more in $250 or more in monthly cash flow. So, and then if you factor in the fact that I could have bought that property day one, owned it for 6 months now versus this one I bought, took 6 months to get it ready. And it wasn't quite 6 months, it took like 4.5 months to get it repaired and then rent it out and that kind of crap. Yeah, there was missed opportunity costs and rent, all those different things. So that was the first Burr, not a home run by any stretch of the imagination. And the whole video is like themed around me saying that I took a swing and a miss. My second Burr I did in Gary. Know the market much better. Definitely knew that I was going to get my appraisal, even though interest rates were going up. My appraisal that I was hoping for 90,000 came back at 134,000. So, I mean, blew what I expected out of the water, almost like, I don't even know the math on that. Maybe Matt does, but that's like 50% higher than I expected, something like that. And so because the appraisal came back so much, now I have options. I could have actually taken, so I was all in at 55 grand. I could have taken $96,000 out as my max, which means that I would have got paid an extra $41,000 on that property, but I would have created an alligator property. So I didn't do that. I took out enough to pay myself everything back. Essentially, I took out the maximum I could while still having my typical $250 a month or more in positive cash flow. So I did not want an alligator property. I didn't want to take all that extra money out, but I was able to pay myself back completely and get a few $1,000s extra. I think it was like, I think I'm getting like $11,000 more than I actually put into it. Plus a cash flowing positive property, brand new remodeled with a tenant paying maximum rent, Section 8. So my second Burr is an absolute grand slam, but I was a little more familiar with the area, a little more guaranteed concrete that I was going to get the cash out that I wanted. You guys both know Maskey Finance. He was doing one at the same time in Gary, and he was expecting $100K appraisal. It came back at 55. Not good at all. But
oh no,
he also did one at the same time in Chicago, where I got my 90, same house, like a few neighborhoods over. His came back 120,000. So unfortunately, and I think, in my personal opinion, I think it was because I just wasn't educated enough about the Chicago market, because I knew 90K was my lowest I can get in Gary, and I blew it out of the water. And the one that he had a problem with in Gary, I think, was just because Gary is street by street, neighborhood by neighborhood. It just wasn't the right street, wasn't the right neighborhood. Go ahead.
I think the bigger issue is that this is why guys have been in it as long as I have. This is why the Burr is scary right now.
Right.
It's because if you were depending on that money to come out, like you started it and you bought it right. And the famous saying of you make your money when you buy is absolutely true. Because if you hadn't bought those right, you would have lost on one, definitely, and just made much less margin on the other one. So the other thing too is it's like, and Mark did nothing wrong. The issue was, and it's almost always, I've had 2 or 3 occasions, maybe 2, but I know 2, but maybe 3 occasions where the number came back was so bad that I actually said, I'm rejecting the appraisal and I will go to another bank unless we get another appraisal.
Right.
And they're like, well, you'll have to pay for another appraisal. I was like, so long as there's no ties to the original appraisal,
Right.
we're good.
Mm.
If there's any tie, if you guys are going to average them, if you're going to weight them, absolutely not. I want nothing to do with that other appraisal. I'll take it to another bank. And because it was a refi, I could do that. And
Right.
so in both cases, they actually said, we'll completely do away with the first appraisal. And the second appraisal in both cases came back significantly more in line with what the actual market was. And I insisted on meeting both the appraisers there. And I said, I walked through with them and I said, hey, I always like to learn. So as you're walking through, if you can just kind of point out the stuff that you're seeing that's more important to you, I'd love to just better understand the process.
Mm-hmm.
And then when we finished, I then said, hey, I'm not sure if you're allowed to. Are you able to take any comps? Because when I did this project, I had comps in mind. Are you able to take any of those comps? And they're like, oh, yeah. In fact, one of them was like, oh, yeah, sure. Absolutely. Hand them over. The other one was like, we can. But it doesn't mean we're going to use them. They were more cautious about it. I said, I completely understand. I just had done this work because I put all this money into this property. I knew what my project was going to be. And here you go. And it definitely impacted both of the appraisals because they knew that I had done my homework before I bought the place. But to your point on the one that you still made okay money on and the one that Mark lost on, often it's something as you might just be another appraisal. And yeah, it costs you an extra $700, which sucks.
Right.
But would you rather spend that $700 then and get 20,000 more, or get that new appraisal, which likely is not going to be less than 55, like Mark got, right?
Right. Yeah. That was a real bad number. Bad number for him.
If it's that big of an outlier, right?
Yeah.
If it's that big of an outlier, then what really is the gamble?
Mm-hmm.
You know, 1 in 10 that it comes back as low, 1 in 20 that it comes back as low. That's where you have to do a little bit of dice rolling. That's what I've done anyway.
Really good advice on picking a market and not being in 3 or 4, because we don't have the real bandwidth to look at a city and know neighborhood by neighborhood, street by street, to see such a big variance in you guys' 2 burrs in the same city.
Yeah.
Real quick, last thing I would say to Dion's point, the number one most important thing that I would recommend about this whole burr strategy is that shouldn't be your first project. That shouldn't be your first rental property. Like I own 8. By the time I buy these 2, I own 8 other functioning, stabilized rental units providing me cash flow every month that I'm not having any issues from. And at some point, I knew I was going to venture out into more complex projects, but I had that firm foundation first, so that even if these had come back as alligator properties, which is my worst case scenario, I can float or cover myself. And so I was able to work through these projects using the cash flow from my existing properties to repair the projects. So I would not say nobody should gamble like this on their first one. I don't think it's a good idea. And it wasn't a gamble. It was a calculated risk. And again, I still make money on both of them. But don't do this as your first project. Stabilize yourself with something simpler and easier first.
Yes.
So we have multiple different investing strategies with Beth Traverso and Mike and Matt and me, and all of these, and Matt and Mark Matsky, and the different ways of doing this. One thing that's fairly consistent across all of our methods is we say that.
Yeah.
Burr is so sexy sounding, and it gets the BiggerPockets stamp of approval and spread out to everybody that they think it's a way to start because you're recycling capital and you don't need to save up money over and over and over. But all of us say it's an advanced strategy with a lot of risk points, and you want to have a portfolio in place that can handle the problems that can probably pop up. And later, go for it, but don't start with it.
I can't wait for Dion to do his burr because I'm going to help, whether he wants my help or not.
Trying to think of the closest thing to a rehab I've done is flooring.
Yeah, exactly. Yeah,
that's it.
We'll get you a real value add one in the next year or so because you got to spend that money.
To be transparent, I almost had one. I had an accepted offer on a burr this year.
I know.
I got the offer accepted. Looked at from what was listed online. I was like, I would totally do that. And I get there and I need to make the video. That I've been hesitant to do the video because it's still on the MLS. And I don't want to go, here's all the things I found wrong with someone else's property that they're trying to sell and
Yeah, I
then
would
get
do that.
sued or whatever. I'm gonna wait till it's not on the MLS anymore.
Yeah, good call.
And I'm gonna say, this is all the reasons why I backed out of this property.
Yeah. Can I ask the audience a question, Dion?
Go for it.
Do you guys think, the audience, do you guys think a video would be helpful? The difference between a BRRRR and a purchase with a construction loan project, the difference between the two. Do you think, the audience, do you guys think that that would be helpful? Dion and Mike, do you think that would be helpful?
Heck yeah.
I was listening
the
to you
audience
too.
can't answer back.
I was listening to
course
you
they
explain it to Zuber the other day.
Yes.
And he was like, oh, I like that. So he literally said the sentence, I like that.
Yeah, it's pretty, that was part of what made me think of it. The other thing too was just a lot of people think that that's the only strategy is BRRRR, and there just isn't. There's other strategies that work better in other times. Yes, Matt, make that video.
Yeah, dude, make the video, dude. The audience can't answer back audibly.
I can read.
I texted you before I went on.
My bad.
But I'll set the $5 here. And the next time you come onto a live, I will call you and then I will take the $5.
Awesome.
Appreciate it.
Yes, okay. T, you got it. Fansel Bruni, you got it. All right, cool. I'll make that video.
No, I think that there's a lot, just like
Gotta
Bird
watch it.
talked about, and it's very sexy. You know, it's very promoted. For a long time, I remember me, Kevin was always talking about the 203K loan, 203K loan. But
Yes.
there's complexities that go along with it that I don't ever feel like he ever fully spoke about. And, you know, sometimes you'll call a lender and be like, well, what about a 203K loan? They don't necessarily know what you're talking about. So you kind of have to be educated on it and the process and how to qualify and how much repairs. Like, can it be ripped all the way down to studs? Or does it just need to be a lipstick flip that you can get a financing for on a 203K loan? I have no idea. I've never done one or used one. I've just done BRRRR or purchased turnkey. So I think that's a good video for anybody, because a lot of people, I think Dividend Dave is considering doing something like this, moving from where he's at, doing his 4-3-2-1 method, jumping over to another one that maybe has more equity upside with a remodel fix and flip loan.
So I've done BRRRRs, I've done 203Ks, I've done 203K simplifieds, I've done construction loans, I've done pretty much every flavor of them that there is. And there's some things you can, the BRRRR method is the least flexible. If that gives you any indication, BRRRR method is the least flexible.
So I like that you referenced Meet Kevin, because he has a really good strategy for growing a YouTube channel. And you talk about the 203K loan. You don't talk about that there's a streamlined version. There's a non-streamlined version that you have to find a contractor who understands how you get paid after each portion of the project is completed and all of the steps. But he explains, look at this thing I did that you could do. So it sounds like somebody to follow. He doesn't say how to buy a real estate property, right? Mm-hmm. He's very smart. He gives away the concept, sells the how-to. So he's got the course, but he gives away, well, you just buy a wedge deal. And then everyone's own mind creates what they think a wedge deal is.
Right.
You ask 5 different people, you get 7 answers, right?
Correct.
So he's really good at creating that little bit of mystery to say, you should click on this video, you should watch this video, you should keep going. And I don't think that's what we're very good at. I think we are, here's the nuts and bolts of real estate investing and how you make work optional. And so we don't get as many views, and I totally get it. But I'd rather give away the how-to than create the mystery.
I think I'm going to make 2 rude predictions. I think that because I have a course coming out, I had to look and see what the market was. He charges $6,500 for his course. And I think he's only done 13 projects. 13. That's pretty nutsy. That's pretty ballsy. I think he's done 13. 13, maybe 14. And he's charging $6,500 for that knowledge. That's a little bit scary. And the second thing is house hack. Like the fact that he's got a company behind that and he's doing that, kind of crazy. It's very interesting. And they've raised $30 million in funding, but it's from a fairly small group of people. I'm very interested to kind of see how that goes, because I'm not sure. I think that the market already has the solution to that. It's called house hacking.
I have a lot of respect for what Kevin's doing. And I don't live in California, but
Yeah.
I would have relocated and voted for him if he would have been able to become governor. The thing, he was running as a Dem, but his platform was everything that would help in a lot of ways. So I was totally supportive of that. I'm concerned when you have a YouTube channel and you make videos and you say, here's an investing thing that only accredited investors can invest in with me.
Mm-hmm.
So this video is not a sales pitch, but it's a video talking about that investment that's going out to mostly not accredited investors.
Mm-hmm.
Yeah, that's
now it's accredited, but they expect approval. I think it's next week for non-accredited investors. Yeah.
He's doing the Grant Cardone method. Same thing Grant Cardone did. He kept just building up this wonderful advertisement for his amazing investments that unfortunately you can't take advantage of. And he let that hype build behind it. And he let the comment section and the live stream build. And we want to get in. We want to get in. Are you sure? I don't know. I don't really think I should work. Well, and Grant Cardone's exact line was, my wife pushed me to make something available to the average everyday man. So I'm going to make something available to non-accredited investors. And then they released that product and people flooded the market for it. And Meet Kevin's literally following the exact same blueprint strategy, which is comical to me because Meet Kevin, one of the other ways he got famous was by roasting Grant Cardone for that and making exposed videos and pictures of like him and Grant Cardone in jail with each other, like as the thumbnail, like just so very interesting.
Restraining order put on him because he used false pretenses to gain access to Cardone's building
and ran around and trespassed and wouldn't leave, and then live streamed the whole thing, which I watched, which has since been taken down. And I remember thinking at my time, what are you doing? Why are you doing this? You're so dumb. You're going to get arrested. And he was luckily not arrested, but
it would have been okay to be arrested because it turned into the YouTube channel that it did.
That's true. That would have been content.
I mean, I didn't get to make a YouTube channel out of it, but I get to honestly say I have never been arrested in the United States. So we have a super chat here from James J. Thank you. I appreciate that. Thank you, gentlemen. Great and helpful content as always. And I'm going to make sure that I'm not missing a question from you, James, just in case. I always want to
everybody liking the video. Let me check. I got to make sure that the commenters are staying honest down there. 30. I'm seeing 30 likes. I think we could do a little better than that. I don't know if it's better than that.
Ring Seeker.
We're at 29 before you joined, Mike.
I brought one and it was my own.
Ring Seeker says, I'm on the retirement train. I plan to use cash flow from properties plus W-2 cash flow. The boost from W-2 cash flow gets me there quicker, which is a great way to look at it. I reached basically financial independence around 2016. Financial freedom started to happen around 2018. And then I continued to work for 4 more years. Because the income snowball of a W-2 job and enough cash flow to be saving about 60% of rental income on top of the full retirement or income savings from the job added up to a lot more cash flow than I ever expected to have, which made it actually kind of felt silly working the first 6 months of this year, thinking I'm making, twice my salary by not having to get out of bed. But the reason I wanted to talk about Ring Seeker's comment here is because I have 2 gentlemen with me today who are still working. And Mike, I get you're hitting 8. You have 8 rentals. You're at the 2 birds. You're growing your portfolio. You're investing in Gary, Indiana, where it's $250 a door to start and grows from there, right? You probably have some deals that are better. So you're building to that. You probably have, I would guess at a minimum, maybe 2 or 3 more years before really walking away from work becomes an option. And then after that, I mean, you're probably going to continue to work and just add units because you're broken like me and Matt. And Matt's continuing to work. How would both of you continue to grow your portfolios if you stopped having a W-2?
Matt, you go first. You've had more time to think about it.
There's no wrong answer, Mike.
I have some ideas, but
I think that it depends on where we are in our construction projects, because ideally we'll take on typically one massive project where it's like a complete gut rehab all the way to the studs. We're going to spend you know, a couple $100,000 on the building. We like to do probably one of those at a time, but usually they're like a year apart. And then right now we're doing 3 of them. That was not planned at all. It was just, you take the opportunity when you can get it. And so I think that the portfolio will grow at the rate by which we find great deals, because we'll still add amazing deals. We won't add, like, we had a flip that we could have done and we would have made like $30,000. Not worth my time. Not worth my time. Not worth the energy to make 30 grand over a 4-month period of time. Having to manage the process, look at everything. Like, it's just not worth it when we can spend our time, because time is my bigger commodity now, not my cash. My time is my bigger issue. And if I can spend the time and make a property right that's going to give me that return, I don't want to spend time on flips or burrs. And that's why I'll do them a little bit differently. I'll do them differently with a construction loan. So that's my take on it. But still working. I don't know if that will change when I retire.
Yeah. So for me, I am definitely interested in not being in law enforcement anymore. I love my job. Don't love the area that I work. It's not super great if you're going to be a law enforcement agent. You know, I mean, I may as well take my felony cases and just put them directly into a shredder because they don't get charged. Doesn't matter what they did. So it's very difficult and frustrating to feel like you're working extremely hard. You're finding, you know, for those who don't know us on the SWAT team, you know, we find extremely dangerous people, or worse, predators of children and things like that. And when it's so unbelievably hard to get the worst people you can imagine prosecuted, it's kind of disheartening. A lot of people are frustrated by that. And I want to spend time with my kids. So I want to get retired as soon as I can, you know, and if I can do it in 2 to 3 years, he'll be 8 or 9, you know, maybe 10. And then I get to spend his teenage years and we get to do boxing and jujitsu and go to the gym and play sports and all the things that every father wants to do with their son. I just have to get myself the free time to do it with him. So my plan is to continue growing a real estate portfolio forever. I don't have any desire to stop, to slow down. And how I would do that, the first thing I'm going to do is, before I retire, I will have not only replaced my entire regular income, but I'll have ideally doubled my regular income that I make as a police officer. Because if I was able to invest with this income, if I can double it, I'll still have enough extra surplus money to continue investing. So I won't make the mistake that one of my friends did, who retired too early. And he was very excited to retire with his rentals, and he did retire with his rentals. And then he moved and he bought another house. And now that house payment, man, it's close every month, because he a little overpaid on that house. And he wasn't as set up for success as he thought he was going to be. And so I'm going to do what I always do, which is estimate conservatively. Nope, I need even more money to retire than I think I do, so that I can keep investing. And so, yeah, so that will be the number one thing that I do, is make sure that I have a surplus of income I can continue to reinvest. Number 2, obviously, over time, rents will go up and equity will go up in properties, and I'll be able to take out HELOCs. I've gotten, or, you know, lines of credit, things like that, do BRRRR projects, value add. So I will continue to do that strategy as well. But back to my first point I made earlier, you want a firm foundation. And lastly, this is what I talk about lastly, because this isn't applicable to everybody, but it's the truth. I'm going to tell you because it's applicable to me. 100%, when I free back 50, 60 hours of my week by not being a law enforcement officer, I will put 40 hours a week of work into YouTube. And I will not only go as hard as I can to blow up my own channel, but I will edit and provide content to you guys to try to blow up everybody's channel. And what people don't know is, I don't make money from YouTube. I mean, I maybe make like $80 a month across all my videos that get viewed. Like, it's not something that makes money for me. Never has been, but it will be at some point, probably, because I know my own work ethic. But some of these guys who have YouTube channels that are big YouTube channels, they make a lot of money. That's why, another reason why, as much as I I do like still meet Kevin and Graham, Stephan, you shouldn't take real estate advice from these guys, because they can do dumb stuff. They can afford to lose money because they have these $100,000 a month or more grossing YouTube channels that can float and cover any of their mistakes. Anything they screw up, the market goes up, down, they make a bad investment. Well, that's fine. I can just operate off the cash flow on my channel. Then from their channel, they have courses. And the whole reason why people like me, Kevin, who have done only 13 projects, and the last one he did was a few years ago, can make so much money is because the real money is in the courses. If they sell $650 a course and they've got 2 million followers and they can convert just 1% of those followers, that's 20,000 people times 650. It's insane.
$6,500.
6,500. I mean, you're looking at
It's
millions
crazy.
of dollars. They're making more. And this is why so many fake gurus, so many scammers, which is, I've done a few exposed videos on those guys. They realize the money isn't in doing the real estate investing, isn't in doing the crypto investing, isn't in doing the stock market investing. It's do a couple of positive deals, replay my greatest hits, and sell a course to the end of time. And that's how they want to make their money, which is why I don't respect a lot of them.
Yeah.
So I'm going to see if my technical skills work well enough to make a short out of this, but so the question comes up of how do you continue to invest if you no longer have a W-2? And this came up in a mastermind that I was in yesterday. I do this every Thursday. There's a Seattle Investors Club mastermind. The question came up. I retired this year in July. How do you continue to add to your portfolio? And two things actually kind of came to mind. The first one is money's not real. And as soon as you understand that, it's a lot easier to make money, especially when you can prove to a lender that you understand money's not real. If you can get rental income on your tax returns for more than 2 years that shows a profit, when they factor in things like depreciation and write-offs and things that you can't use against your W-2 income, and take depreciation out and show a profit, lenders will continue to lend to you, even if you don't have a W-2 job. For those first 2 years, it's very important that you have a lendability factor with lenders. But once you have that 2 years of rental income, I've had lenders tell me, regardless of your W-2 income, you can buy a property of any value that you want that you can save a down payment for. And here's how I prove to myself how money is not real. Christian and Cody Multifamily Strategies had a guest on recently, and she was talking about her portfolio. And I think she's 24, she's 30 rentals, and they bought a duplex a few months ago. And I want you to think about this. If I asked you, you guys have kids, last month, did you buy milk? And if I said, did you buy milk? Was it $4 a gallon or $8 a gallon? You probably have an idea which one it was closer to. She said, we bought a duplex a couple of months ago. I don't know, it was like $89 or $180 or $190,000. It was somewhere in there. Money is not real. A $10,000 variance on an asset that's going to produce cash flow doesn't matter enough to commit it to memory. But knowing if milk costs $4 a gallon or $8 a gallon is something almost everybody has in their mind. If you get to the point where your assets are producing the money and you don't have to sell your life 1 hour for it at a time, then you'll realize money's not real. And as soon as you get that in your mind, it's a lot easier to make more than you know what to do with. I'll see if that made enough sense to put up as a short.
It is way too long for a short, but I digress.
There's two. Got the first and the second.
Yeah, part one, part two, yes.
Short can be 1 minute, right?
Yep. 1 minute on
yeah.
YouTube. You can do 3 minutes on TikTok, Dion, if you want to go hang out with teenagers.
Yeah. Yeah. He doesn't have an
So here's why I generally don't do shorts or TikTok or Instagram. And it's not an age thing. It's an education thing. If the goal was to grow YouTube, yes, I'd be doing all of those things. I'm on Instagram because I have it connected to Facebook. I'm on Facebook because that's where my kids are at. And so I post on Facebook, it goes to Instagram. I don't think I've logged into Instagram in over a year, right? But anybody watching a reel or a 1 minute short or a 3 minute TikTok isn't there for education. They're there for entertainment. And as funny as I think my own dad jokes are, I like to tell dad jokes, but he never laughs. I don't do this for entertainment. I want to educate people. I want to take people and say, work is optional. You have to work for a period of time, but you don't have to continue working. And there are people who it takes 10 minutes to get a concept across. And so that's why I'm not on that short content, and why I'll probably always have a smaller YouTube channel.
You're wrong. Let me prove it to you. And I love you.
Okay. I'm all open ears.
I was the teenager when YouTube came out, 2006, and I was like 15 years old. Between 2006 and 2010, everybody said the exact same thing about YouTube. If you're there for 5 to 10 minutes, you're not there to be educated. You have to be educated in an hour-long seminar, attending schools, curriculums, classes, and studying from books. You don't get educated in 5 to 10 minutes. YouTube's just for entertainment. It's a bunch of musical people and comedians. It's not actually going to be used for anything substantial ever. And you fast forward 10 years, 12 years, we're at the same thing with TikTok. Now, I remember when TikTok first came out. When it first came out, it was just a bunch of musical people and silly comedians. And I had a TikTok account that blew up, and I just made silly jokes about being a police officer. But very, very quickly, everybody realized this is the next big thing. And we need to start putting content on it that's going to get people's attention. And and the same thing happened with YouTube. Started out with entertainment and very quickly shifted to any topic you can think of at all you can learn about. TikTok is the exact same thing. The way that they get around the short form content that you're talking about is, as what Matt said earlier, there's a part 1 and a part 2 and a part 3, which drives traffic to your profile because you upload a 5-minute video and you break it into 1-minute segments. And part 1, part 2, part 3, one of those goes viral. You now have 5 chances to go viral instead of 1 chance that you have on YouTube. 5 chances to go viral. One of them kicks off and someone relates to it. They go back to your profile and scroll through all 5 of them. And that's why TikTok is growing at a faster rate than any other social media platform that there is. It's blowing stuff out of the water. And the last thing you need to consider is that as human beings, our attention spans are screwed. We have ruined ourselves with the dopamine hits, and TikTok is blowing YouTube out of the water, which is why I think about why YouTube's trying to compete with shorts now, because they know they're losing. Why did Instagram buy Vine 6 years ago, which was TikTok's like original version? They bought it and canceled it because they were getting their butt kicked by it. But then eventually it came back in another form. And then instead of buying it, shutting it down, Instagram bought it, or excuse me, incorporated and made their own version of it. So you could say, oh, people aren't going to seriously use it for education. But I promise you, give it 3 or 4 more years, TikTok will probably pass YouTube unless YouTube Shorts figure out how to come back and hang with the crew. And people are using it for education. Shoot, I have watched TV shows on it because, oh, shoot, I just saw a 30-second clip from this show that I really like, this action scene from a Marvel movie. So boom, you hit the guy's page and you just scroll and you can watch 30-second clips of the whole movie. And I'm like, why am I doing this? I could just go put it in my DVD player downstairs. I'm like, I don't want to go downstairs. And I just keep watching.
No, I could totally see it. I mean, it's kind of like, will you watch a 10-hour movie about dragons and magic? No. But if you break it into 10 1-hour episodes, Game of Thrones becomes one of the biggest shows there are, right?
Yeah.
Exactly.
So I get it. The reason I'm not on there is because it's not the form of teaching I can do, the short content. It takes me longer than a minute to get the idea out for the question I'm trying to do, which is why, again, smaller YouTube channel. So my goal isn't to grow YouTube to be a huge channel. It's to educate the people who are looking for, how do I make work optional? If I had your skill set for the editing and to put it into the 1-minute content and do the chain, maybe someday, but not today. Yeah, and you have a very valid point. I absolutely agree with everything that you said.
I agree with everything both of you said. Now, quick question, Dion. Did you had a number this year in the last 12 months, how much more money you're making from your rentals just with rent increases?
So just rents from profit. So I don't know what the total number. I always remember the net because that's the number that I actually care about. 128 last year. I have one tenant whose rent was due on the 8th and she wouldn't be late for another 5 months. She hasn't paid yet, but if she doesn't pay, it will be off. But 203,000 in profit this year. So whatever that percentage is.
So we went from 128 to 203. Okay.
It's like 03 something, but 03 rounded off, right?
It's good enough. It's good enough for my math purposes.
That's
so
crazy.
I mean, basically that's, it's like 50, 60, it's like about 60%. It's about 60% is what it is. That's how much, and that's all to the bottom line. So,
right, and it's all the profit. It's after setting aside, a little over 3,000 a month for reserves, which technically reserves is full. So that's going to the investing fund.
Yes.
So that's even more than that. It's literally why when around July came and I was having that great day at work, I was looking at the income. I recently done a video where I whiteboarded at work. If you take my income from this year, and it was even less than that, I wasn't projecting it to be where it ended up. I was way too conservative. I expected to have more repairs and maintenance this year too, beyond what I set aside, and I just haven't. I was looking at what I was making on the whiteboard at work, doing a live, like a 10-minute live, just a short little, this is how much I make an hour. If it was a 40-hour work week, this is how much I make an hour. If it was 24 hours a day, And I was standing in the office going, it's stupid for me to be here. So
That's awesome. Yeah, because we're doing all of our stuff for this year for taxes for next year. And it was awesome.
someday you might share your numbers with everybody in
All
a
right,
video where
I'll
you're
share
like,
that.
it's ridiculous numbers, right? But
I'll share that number. That number was I gave myself over $250,000 raise this last year on rent raises.
and it's what's funny about this is why we're trying to drag people kicking and screaming from, if my boss gives me a 50-cent an hour raise, I'll make $2,500 more this year or whatever based on their overtime. And people are trying for that instead of, let me take my money, right? I'm not going to spend it on a bunch of stupid stuff. I'm going to buy an asset. It's super boring. I'm just going to buy a rental and the tenant's going to pay me more than the mortgage is.
Yep.
And then we overthink it with all the other things we throw in there, but that's the basics.
Yep.
I want the tenant to pay more than the mortgage costs, whether there's 2 or 3 tenants, 2 or 3 units, one house, doesn't matter. Basic concept. And I'm going to do it a couple of times. And all of a sudden, money is not real.
Well, no,
I have a well issue. My well goes out, right? I go to the house. Each tenant of the other 3 units come out and talk to me separate times because we never all interact with each other, right? And they give me a raise. During that conversation, they say, hey, can we please raise the rent?
Right.
Like that doesn't happen if you think money's real. If you think you have to work for it.
Yeah. I mean, I think, that was, as I looked at it and as we did, our version of the binder strategy with folks and went through it and had, the number was ridiculous. It's ridiculous. It's ridiculous.
It's why, I mean, I make jokes. I would of course love for you and Zuber to share numbers to motivate some that might even be numbers that motivate me to go, maybe I should grow a bigger portfolio, but I'm probably not gonna. But I totally understand why we don't. It makes sense.
There's a reason why I won't be doing a video about that.
Right.
But yeah, I mean, $250,000. It's like I always knew that eventually I would make that kind of money. I always knew it because I knew that I was smart enough and I knew that I would work hard enough to get there. So I knew that I would always eventually get there. But for that to be the increase, on the income coming in is obnoxious. That's why I don't share it usually.
So if there's anybody who is in this live that isn't a recurring, constant, returning visitor that's using our education to reach financial freedom, really quick, we have Millennial Mike, who is a first responder, who has a single parent with a son who is investing at a distance out of state, building a rental portfolio. He is also house hacking in a high cost of living area. So you call it blue collar or white collar working?
I wear the bluest collar.
Or the bluest collar. This is actually literally blue, right? Reaching financial freedom by consistently doing something boring like buy rental properties. Then we have Matt, the lumberjack landlord, who attended school. Did you go to the 9th grade?
I
Briefly.
went. I went. I didn't finish.
Didn't finish 9th grade. Okay. And you have 3 kids. You've been married. How many years have you been married?
16. We've been together for 17 years, married for 15, and I have a 5, a 3, and a 18-month-old kids. And
I always get the count wrong because it's a moving target. Last count, 135.
Oh, 137. Yeah,
137 rentals.
Big dog.
Right. Both of you continuing to currently still work.
Yes.
Sharing your knowledge. So Mike, you're my go-to, the Millennial Mike, you're my go-to when somebody says, I'm looking at investing out of state. How do I pick a market? How do I find a property manager? How do I manage rehabs at a distance? Like, here's the guy I send you to. Matt, you self-manage, you and your spouse, and you have, 137 units. You've got $500,000 in rehabs going currently. You added 18 deals last year.
So I think we've done 17 deals in the last 18 months.
Okay.
Stud.
So This is the knowledge being shared today on this live stream. We all three have our own YouTube channels. We have Millennial Mike, who with his work schedule does live streams occasionally, and you should go to his channel and set up notifications so you know when they're up. And Lumberjack Landlord does live streams on Sunday mornings at 8:30 Pacific. Is that 11:30 Eastern? And then every now and then we'll do something on a Friday, and we'll rotate through whose channel we're on Fridays. All of us are open with our information. We share our contact info. We're on Facebook, social media. You can connect with us. We answer questions in live streams like this. Sometimes we don't have time to get to all of the questions, so we'll go through the super chats first, because that helps YouTube know that maybe we should share the content with someone else. And every now and then we do a thing where we give away an hour consultation, where we do, or I give away an audiobook. We tend to do that on our channels. So next Tuesday I'll be giving away. I gave one away this Tuesday that Phil won, and we're going to be doing that call this Saturday. And I want to take a minute and thank you guys for sharing your time, trying to help the people that come to channels like this, where most of the people, I've done a couple of polls, most of the people who watch content like this are working. I think it was like 64% haven't done their first deal yet. So there's a big mountain of fear to get past, a larger mountain of fear porn videos on YouTube talking about the crash that's coming and why you shouldn't buy. So I think it's great when somebody finds content where we're saying what's happening in the market doesn't matter. What's happening in your life matters. And when you find a great deal, buy it. Because there's never been a time in history where we all wouldn't like to go back and buy a property at the price that it was. Even 2008, before the housing crash. Imagine right now being able to buy a property in your market for the price that they were in 2008. So long-term, buy and hold, it works out. I think with that, we're probably going to wrap up, unless there's anything that you two wanted to cover really quick. If you want to look through the questions really quick and see if there's anything that your all-nighter hider hasn't won yet, it's all rigged.
No kidding. And he's got double the chance because he's got 2 YouTube profiles in here liking and making comments, and he makes more comments. All Nighter Hider. Next time Dion says, okay, start listing mythical creatures that you like, just start 25 comments in a row.
Actually, Hyder's going to be on my channel next week. I'm trying to, because my YouTube time weekly is limited, I'm trying to find the pocket, but Hyder, I'm going to interview Hyder because he's in all of our streams, and I think he's a good dude, and he's helped all of us out, and that's why he's got the wrench.
Yeah.
So I'm going to interview Hyder next week and hang out with him via Zoom.
Yeah, he's a good dude. He was at the live event. He's extremely supportive, real friendly guy. There is one question we have to answer though, because James J did do that super chat, and then he immediately asked a question after that. A couple more questions down. He asks, what resource or resources is best for putting together comps? So Matt, you're probably the best one to answer that question.
So comps for rent are whatever's used in the market. So it might be Craigslist, it might be Zillow, it might be apartments.com, it might be Facebook Marketplace. And so it's interesting because most people think comps and they immediately go to comps for houses. The best place for comps for apartments are the places I listed. The best place for comps for houses are your agent. Your agent should be giving you some sort of a comp list. You can also, if they don't have that, part of Mike Zuber's One Rental at a Time is basically building the comp list yourself over time. But what you can actually do is you can actually do a backwards 60 days in almost every MLS system, and you can build your comp list right then and there. Which is basically just, what are you searching for? 3-bed, 2-bath in these, 2 zip codes. And you can literally fill out a spreadsheet showing what all those comps are. And that will give you an idea of about what you should be paying.
He asked that question back when we were talking about doing cash out refinances on a BRRRR. So I think maybe he might've been talking about comps as after repair values.
Yep. So I'd be looking at MLS for at least a 6-month period of time with entering in the criteria that your house is. For me, I have 2 towns that have almost no volume. And because they have almost no volume, like they might, in one of those towns, they might sell 75 houses in a year. So likely that they're going to find something like my multi that sold in the last year. Chances are no. So what I've actually done is you can go to the neighboring towns that, that might not be in the dead heart, but right closer to the where you own your property in the other town. And then, yeah, admittedly, I'll pull comps that are the closest to the story that have the highest number. And that's what I provide.
So that was going to be my question for you, Matt, because I've actually been looking at a 5-plex that I think I'm going to be able to talk them into seller financing me at a fantastic deal because they can't sell it because nobody can get lending for it because it's a weird property, needs a little bit of work, not fully occupied, and it's a 5-plex. Like they can't sell the property. And so my initial thing is, okay, well, how much is this actually worth? How do I accurately do comps? Because guess what? There's no other 5-plexes that look anything like this anywhere at all that I can find. So how do you know what it's worth? I mean, yeah, I can just be like, okay, a duplex times 2 plus 50%. I mean, that's very rudimentary if that's even applicable. But how would you?
So if it's a 5-unit, I would be looking at condition of 4 units or 3 units, and then looking at the square footage and then trying to get there from a square footage perspective. But in a 5-unit, it's most important what the rents are. The rents are the real driver in a commercial property. The rents, they almost always in a commercial asset, almost always they'll take the income approach as opposed to the resale approach. So when you're looking at, 5 and above, usually what you're looking at most importantly is rents.
Right. If you're looking at residential 4 units or less, they use comps, like the question. As soon as you go into 5 units or more, it goes to NOI.
Cash flow. They're
going to say, based on what's your cash flow? Here's your expenses. And with 5, I would look at the layout of the property, Mike, to see, is there parking? Does each unit feel like a unit or a house? Like when you buy a duplex and both yards are fenced, you're probably going to have less turnover than if you have apartment style layout. So increase what you would set aside for vacancy based on turnover being higher. What the comps, go ahead, Matt.
It really depends on, so layout's important. If it's, 5 brownstones, or if it's a building where there's like 4 units, but then they made an addition on the back and that's what made it a 5. Then you can look at 4s, and then you can conservatively book based on 4s or what the per door value is of the 4s that are selling. The difference is going to be debt, so the most important thing is if you can't get seller financing, what is your exit? Because exit on a 5 can be literally less than a 4. Because if you can't get debt, then you're screwed. So when you're looking for that seller-based financing, that's awesome. That's absolutely the way to go. Steve Dow at Velocity would write that as a 50-40-10 deal.
I contacted Velocity Mortgage and they said they couldn't do lending on it.
How come?
Because it is not more than 70% occupied and it needs repairs in one of the units. They were like, if it was 70%, go ahead.
But when it's 70% occupied, they can.
They could, yeah. But then I have to go back to the seller and ask them to put someone in there. And then are they going to put someone in there because it's a good person or because they want to get it sold?
Could you do seller financing short term so you can get it stabilized and then finance?
Possibly, yeah. And so right now, the only way I'll do this deal is if I seller finance it. And if I seller finance it, I think I'm going to get such a screaming deal that it might not even be worth it to do anything else. Currently it's owned by a church. The church had been using it for a while to help members of their church who were like moving and stuff like that. But they're just tired of being a landlord. Property actually looks pretty good. There's 1 unit that needs more of a remodel, but it's a great location. It's by a church and it's in a nice neighborhood. It's not in Gary, Indiana. It's somewhere nearby. I'm not going to tell anybody, so I don't want anybody to start Googling. but yeah, if I can convince, the deacons or whoever it is, the group it is, the people I got to chat with, because right now I've just been chatting with one person. If I can convince them, it would be a very good deal. I'd be very happy to make that video.
Yeah, that's a huge win.
Okay. Well, with that, I think we're going to wrap it up here. I look forward to talking to everybody on future live streams. Trying to think of anything that we're missing before we're out. So if you're in the area, and like Tony, I will see you this weekend at the Christian and Cody multifamily strategy meeting at the Robin Hood Resort. Looking forward to being there. Until my next video, thanks for coming to my Dion Talk. There's a 90% chance we're